Hey everybody, Jeff Morrell here with eXp Realty here for the August housing market update. Can you believe we're heading into fall and winter here soon? Anyway, guys, thanks for taking a look. If you've watched this before, I do this more on a nationwide basis because I am working with agents all across the country. I am looking to do this here for the Colorado Springs market here soon. But let's jump into it. We got a lot to talk about here. We're going to be talking about what's happening in the current market, why the market won't crash. I really don't believe it will. We'll talk about that. And the big one that everyone wants to know, what's ahead for the forecast, the rest of this year, 2022. What are the experts saying we're headed for? So I'm going to jump right in with our first topic. We're going to get started with what's happening in the current housing market. Now, I think we can probably all agree that this year is really being defined by inflation and rising mortgage rates. Well, what you're looking at here is the Freddie Mac 30-year fixed rate from January all the way through to the latest data we have today. And what we can see over time is that mortgage rates really ticked up week after week after week. And they started to potentially peak right around the mid-June, end of June timeframe. Right now we're seeing a lot of volatility. I think we're going to continue to see that here for a while. I don't think we're out of the woods yet. I think we'll see a little bit of a rise in rates. We'll talk about that, but I do think they're going to settle down here soon. Where are we today? A little bit lower than where we were about a month ago, but we're still watching these rates. So a lot of this has to do with the moves that the Federal Reserve is making to ease inflation. I said this last month, that inflation is the enemy of long-term interest rates. And that's exactly what the Fed is trying to do. They're trying to ease inflation. As that starts to happen, as we saw in the last Federal Reserve meeting, they raised the federal funds rate by 75 basis points. Now, when that happens, that doesn't dictate where mortgage rates go. But it started to signal that the Fed is trying to get inflation under control. Now, I'm not going to get into politics of all this. There's no way. But we all know the widely held belief that a recession is 2 consecutive quarters of negative growth. If you look at this chart right here, you can see that going all the way back to the late 1940s. Every time we've seen 2 consecutive quarters of negative growth, a recession has been called. The reality is what we want to break down in the housing market is what the data says and why not to fear a recession for the housing market. So how would the housing market be impacted by a recession? What we want to do is follow the data and what the data tells us about historical context. So if we look at what the data says, a recession does not mean falling home prices. If you saw last month's market update, or if you follow me anywhere on social media, you've seen this visual. I put this out there. And what it shows is that in 4 of the last 6 recessions, home prices have actually appreciated in value. Now, we all remember 2008, of course, that was the big one, when home values lost nearly 20% of their value. But that's really a very fundamentally different place than where we are today. The market was drastically different. We're going to break down a lot of that today in this monthly market report. But truth be told, 4 out of the 6 past recessions, home prices have actually appreciated. I mentioned this a moment ago. What does this also mean? Well, recession also means falling mortgage rates. Now, as we look at the data about what's happened with mortgage rates over the past 6 recessions, those have also declined. That's what you can see here. This is the decline, the percentage points decline in mortgage rates over the last 6 recessions from the peak to the trough. So you can see every time mortgage rates have ticked down. So that could be really good news for the housing market. Those buyers who have maybe been paused in the process or stepped out of the home buying process altogether because they've been priced out by high mortgage rates. Well, mortgage rates declining could be a very good thing. And if we look at this graphically, what we can also see here, this is a combination of data from Freddie Mac and Mortgage Specialist. It shows how from the peak of the recession to the trough, each of those yellow boxes that you can see across this graph, those are the recessions, how mortgage rates have fallen in recessionary times. Now, this doesn't indicate exactly what will happen every single time, but we can learn quite a bit from what history shows us. And I think this quote from Fortune really helps as well. It says, over the past 5 recessions, mortgage rates have fallen an average of 1.8 percentage points from the peak seen during the recession to the trough. And in many cases, they continue to fall after the fact, as it takes some time to turn things around, even when the recession is technically over. So what does this mean? It means if we look back at what we've seen historically, the mortgage rates have fallen in times of recessions. Those visuals on recession, they don't mean falling home prices. The recession means falling mortgage rates. Okay, so home buyers, this may be a great time for you to jump back in the market if you've been sitting on the sidelines. It may be one of the reasons why housing actually helps us into this soft landing that we keep hearing about. So with that in mind, let's talk about another big question that's on everyone's mind, and it's about a housing crash. What I'm going to break down for you is why I don't believe the housing market will crash. I really don't think it will. I think that the heart of this is in the inventory. Now, we know that there are three places where inventory comes from. It comes from existing homeowners or current homeowners, listing their homes, putting them up for sale. It comes from new construction, so newly built homes coming onto the market. And it comes from potentially distressed properties, short sales and foreclosures. So what I'm going to share with you today is where is inventory coming from? And when we look at the inventory perspective, why that means the housing market won't crash. If you think back to the last time when the housing market crashed in 2008, we had an oversupply of homes on the market. And today we have a big undersupply. Anytime there's an oversupply of homes, more homes available than buyers who want to buy them, that's what causes prices to fall. What I'm going to share with you here is why that certainly isn't the case. Like I said, it starts with the fact that we just don't have enough homes for sale on the market. This is a look at existing inventory. And today, the total housing inventory registered at the end of June, the latest data that we have was 1.26 million units. Now, if we look at that from a month's supply, that's what you're seeing right here. Unsold inventory today is at a 3-month supply. That's that orange bar that you can see over on the right. Now, compare that to the yellow bars. That's the oversupply that we had during the housing bubble when the market crashed. That's because we had more homes on the market than we had buyers to buy them. We have the exact opposite today. And if you look at this comparatively, where we are today, we're nowhere near the oversupply we had last time. And you have to build a case that a flood of homeowners are getting ready to sell their houses. They're going to jump into the market. They're going to make a move, and all this inventory is going to come on the market so fast that it actually tip the scales into that oversupply zone. Guys, we're not even close to being there. The typical neutral market is 6 to 7 months of supply of inventory. We don't even have half of that at this point. We know this number is growing. Be keeping an eye on that because more inventory is coming to the market. That's the tick up we're seeing this year. We certainly aren't anywhere near where we could potentially see the market crash because of an oversupply of homes coming onto the market. That's just not happening right now. Now, the other place where inventory comes from is new construction. This is a look at monthly new residential construction. We've broken it down into 4 stages of construction: building permits and housing starts. Those are our leading indicators that tell us where the market is headed. And then on the bottom, under construction and housing units completed. Those are the lagging indicators, what's happened so far. And what we can see in terms of the leading indicators, the 2 at the top, permits and starts, those are slowing down from May to June. You can see that happening. And that's because builders are saying, hold on, we're seeing mortgage rates rise. We're seeing that softening buyer demand. We're not going to overbuild. We're not going to get started on more homes than we know we can complete. Really being cautious right now. And so while we've had 14 years of undersupply of newly constructed homes built in this country, they're not going to overbuild this time. That's the little tick down that you can see. So some slowing there. If you look at the bottom, especially down at housing units completed, you can see that we're headed to build a seasonally adjusted annual rate of about 1.3 million homes this year. Now that's good. That will add some more inventory to the market. It will help create some options, for home buyers, but we're not on pace to have an oversupply. You can see that May to June ticked down on units completed. So we're definitely seeing more new construction. We're on pace to build 1.3 million homes in this country. We haven't seen that in over 14 years. That's huge. That's a great addition to the inventory, but not anything that would take us to an oversupply like we had when the housing market crashed. Now, the third place where inventory comes from, we talked about this quite a bit the last couple of years, kind of watching things, foreclosures and short sales, distressed properties. The reason that we're not going to see a flood of foreclosures hit the market, a big part of that is because lending standards are under control. Now, back when the housing bubble burst, we had much looser lending standards. They've tightened up significantly, and that's what this graph shows. This is the Mortgage Credit Availability Index, and it shows the higher that green line is, the easier it was to get a loan. What you can see in 2006, 2007, it really peaked, where we used to joke that it was harder to not get a loan than to get a loan. It was much easier for someone to secure a home loan, and that created inflated demand, and many millions of people were foreclosed on their homes because they weren't coming to the table as a qualified buyer. They weren't able to repay their loan over time. Now you can see that green line really drops off, 2008, 2009. That's when lending standards really tightened. That's when we were required to have a more qualified buyer. So those who are securing home loans today, you can see that green line really hovering along at the bottom. They're much more qualified buyers, more likely to repay their loans and not go into foreclosure. So that's a huge difference that we have today. And if you want to see the results of what this has done to foreclosure filings, look at this right here. This is U.S. properties with foreclosure filings. It shows foreclosure activity by year. You can see those red bars. That's when we had over 1 million foreclosures per year. 1 million foreclosure filings per year in the housing market. And the lending standard tightening that I showed you did this. It made it drop right down consistently, starting especially in about 2011. Fewer and fewer foreclosures every year in this country. Now, we can just about take 2020, 2021 out for a second because we know we had a moratorium on foreclosures in that time period. But overall, tightened lending standards really changed the game with a more qualified buyer. Now, I want to talk about where we are this year with foreclosure activity because I think this is starting to come into the conversation as well. I've been hearing this out there from agents and even some buyers, investors. What I want to show you is the first half foreclosure activity by year. Now, this is for January through June of every year going back to 2008, so the first half of the year. That's the latest data that we have right now. So it's the best comparison for you to see where we are today in 2022, knowing that there are more foreclosures coming back to the market. Now, it's not a flood of foreclosures because what you can see is 2022 over on the right has just under 165,000 foreclosure filings this year so far. We can compare that really back to 2020, pretty much on par with 2020. Not even as much as we had in 2018 or 2019 before the pandemic. So we're moving back in the direction of a pre-pandemic year, but not a flood like we had in those red bars where millions of homes were coming to the market as foreclosures. I think we could really look at this and say lending standards have changed the game. We know that there are more foreclosures coming to the market this year, but it's nowhere near anything that could cause the market to crash with a wave of foreclosures. So this right here, okay, I think a big reason for that is the forbearance program. Here's the latest update that we have. This is now a monthly report, and it's the loans upon exiting the forbearance program. So this is current as of the very end of June. What it shows is that 36% of mortgages coming out of forbearance were actually paid off. Brought current, people staying in their homes, no issues whatsoever, just walking away from forbearance, staying in their homes. That's huge. What's even more important, 45% were workouts or repayment plans. So people who were able to do modifications or loan deferrals, they went back to their banks and they changed their situation, and that's huge. This is the opportunity that homeowners did not have in 2008 that they have today, to work out a plan so they don't have to lose their homes. Banks have been adamant that they didn't want that to happen ever again, and the forbearance program changed the game. So what this really shows is that if you put those two numbers together, that 4 out of every 5 homeowners coming out of forbearance, they're just fine. They're staying in their homes. They've worked out a plan. They've paid off their balances. They've paid off their loans. Well, there are those who are still in trouble. 18% have no loss mitigation plan coming out of forbearance. And so that's created some concerns, but truly many of those homeowners with today's growing equity and appreciating home values over the last couple of years, they have enough equity to be able to sell their homes if they can do that, if they choose to do that, make a move and really avoid the whole foreclosure process. So people today have different options that they just didn't have before, and that's huge. That is changing the landscape, and one of the biggest reasons why we won't see a wave of foreclosures coming to the market. Right now, we only have about 400,000 homes that are actually in forbearance. And of course, we don't want any of those to go to foreclosure, but even if they did, even if all those homes, or even if those homeowners all sold those homes before they foreclosed, we have such an undersupply of homes on the market today that they'd be scooped up instantly and it would not cause a crash for the market. So I think this quote from Rick Sharger from Adam Data, this is the group that follows all this. This quote's really powerful. It says, foreclosure activity across the United States continued its slow, steady climb back to pre-pandemic levels in the first half of 2022. It's exactly what I just showed you. While overall foreclosure activity is still running significantly below historic averages, the dramatic increase in foreclosure starts suggests that we may be back to normal levels by sometime in early 2023. So while we're seeing more foreclosures this year, that's because we didn't have really any in 2020 and really 2021 roughly. We're seeing some of those come into the market, but certainly not like we did when the housing market crashed. So I think if we look at this perspective, the three places where inventory comes from today, if you look at the months of inventory of homes for sale, even if we have homes coming from all three of those places, we're still in a seller's market. That's the white line, down here in the bottom. You can see where it says, today, right about the middle of the picture here, the graph, that inventory line is rising. It is climbing, and that's great news for the housing market, but nowhere near those 2008 to 2010 regions where we truly had an oversupply of homes on the market that caused the housing market to crash. So as we think about that, three places where inventory comes from: existing homes, new homes, and distressed properties. Nothing that would cause the market to crash. Really important data, for buyers and sellers to see so they can make powerful and confident decisions about why this market won't crash. It's a big question on everyone's mind. And this data and historical context really helps to frame up that conversation. Now, we've talked a lot about where the housing market is today, why it won't crash, but I think one of the big questions on everyone's mind is what's ahead for the rest of 2022. So let's dive into the expert forecast. What are experts saying is ahead for the rest of this year? Well, we started this conversation today talking a lot about how mortgage rates have been rising since the beginning of the year. And I think one of the big things everyone wants to know is where are mortgage rates projected to go? This chart is a look at mortgage rate projections that were just released in July from Freddie Mac, Fannie Mae, MBA, and NAR. Now, if we look at these across the board, we can average them all out over each quarter. And that right column there, it shows the average of all four. So what is it telling us? It's really saying that mortgage rates are projected to kind of hang in this steady space right about where we are, right now. So that's great news for buyers who might have been priced out of the market, who have pressed pause on their plans because mortgage rates have been rising so rapidly. But here's the thing. We're also going to be looking at all the economic factors around us. We've said a lot that inflation is the enemy of long-term interest rates. So what do we need to do? We need to keep watching where inflation goes. Mortgage rates tend to respond in this case. And as the Fed makes moves to raise the federal funds rate to ease inflation, we know that does not dictate where mortgage rates go, but it certainly is part of the conversation. As we talk about recession, what typically happens to mortgage rates in those times, all these factors play in to where mortgage rates will go over the next year. So according to the experts right now, they're saying, they're holding a fairly steady, pace right here in this low 5 range. Okay. That means there could be a potential silver lining for buyers. So I want to share this next quote with you because if that's true and mortgage rates do hold steady, I love this quote from CNBC. They're quoting Joel Kahn from the Mortgage Bankers Association. He says there could be a potential silver lining for the market, as stabilizing mortgage rates and rising inventory may bring some buyers back to the market during the second half of the year. So great news for buyers. We certainly do hope it's true that mortgage rates hold steady. I'll be keeping my eyes on these rates. A lot of us realtors, we will. Okay, another question on everyone's mind: what is projected to happen with home prices? Well, a survey of almost 400 agents was taken. They were asked, what's the biggest question that your clients are asking you right now? Well, the answers were the crash and pricing. They want to know, where are home prices headed? Well, if you look at what the experts are saying, this is the home price forecast for 2022. Here are 7 key industry leaders on home pricing. These get updated, by the way, some monthly, some quarterly. And if you look at them and average them all together, the average of all 7 is showing 10.3% home price appreciation through the end of this year. So as we look at this year, we are certainly seeing a slowing, a decelerating price appreciation. Last year we had an average of 15%, according to CoreLogic. Homes appreciated by 15% over the year. We're not necessarily looking at that much appreciation, but nationwide in most markets, experts are saying an average of 10.3% appreciation as we go forward. Now, I say nationwide and in most markets because I think this quote really is telling. It's from Mark Zandi at Moody's Analytics. It says, I don't think national housing prices will decline in a meaningful way, but there will be some price declines across the country. So you may be feeling this already in some markets, depending on where you are. And there are pockets in the country maybe that are overheated, that have appreciated significantly, that will likely see declines that may already be happening where you are. But overall, because of undersupply compared to demand, experts are saying continued appreciation through the end of this year. The other question that's on people's mind is, what does this mean for home sales? Well, we've seen a little bit of a slowing in the pace of home sales. We've seen a softening in buyer demand due to those rising mortgage rates. So what does this mean for sales? Well, if we look at what NAR tells us, this is the projection for existing home sales. This is seasonally adjusted annual rate in millions, okay? So what this means, if you look at that orange bar over the right, NAR is saying that at the current pace of sales today, if we continue on this pace, we are projected to sell 5.1 million homes in this country this year. Now look at that compared to 2020 and 2021. It's a drop off, right? Well, those were exceptional years. They were totally abnormal, out of the ordinary, okay? Existing home sales went through the roof due to all the record low mortgage rates, the changing needs of the pandemic, all the stuff that went into all this. And what this probably feels like right now, if you're a realtor, this analogy I used last month. Last year, you were driving down the road at 80 miles an hour. You were cruising and you came around a corner, you saw the flashing lights, you slammed on your brakes, right? Suddenly you're going 60, 65 and it feels like you're crawling. Well, that may be what you're feeling right now when it comes to home sales. However, you're still going the speed limit, because if you look at the orange bar compared to the pre-pandemic years, 2018, 2019, much more in line with the pre-pandemic years. And let's not forget, those were great years in real estate. So home sales softening a bit, but still projected to sell 5.1 million homes in the country this year. And if we look at that from a total home sales forecast, this is from Freddie, Fannie, and MBA, we can see that those blue bars were what the experts forecast back in January. That was before mortgage rates took their climb. And then the reforecast in the orange bars is the latest from July of 2022. So the latest data we have right now, a little bit of softening in total home sales. We sold about 7 million homes last year. We're looking more like anywhere between 5.8 to 6.4 million total homes sold for this year at the current pace. Now, again, still very strong years in real estate. And what I want you to think about too is that this is pretty typical for the experts to reforecast. Coming in high at the beginning of the year, we see how the year has kind of shaken out, and then they reforecast. 2020 was a great example. They forecasted down, and then we actually exceeded expectations and sold a record number of homes that year. So the reforecasting is very typical in the real estate industry. So mortgage rates projected to hold fairly steady, home sales softening just a little bit, and prices projected to continue rising at a bit more of a moderate rate in most markets. So what does all this mean? Well, this is actually a great visual. 3 reasons to buy a home today. If you think about the forecast where home prices are, buying before prices rise higher, mortgage rates holding kind of steady, inventory is starting to tick up and come back to the market. There are 3 things that are happening right now that are creating a great scenario for buyers. We're seeing fewer multiple offer scenarios. So if you're a buyer, you can see in April, the average home sold had 5.5 offers, per home. If you look over on the left, it ticked down to 4.2 in May, 3.4 in June. That's a trend that we're seeing going forward. Fewer homes selling above asking price. You can see that percentage has ticked down from 61% to 51%. Now, don't get me wrong, still a very competitive market. If 51% or half of homes are selling over asking, this is definitely still a competitive market, but a better time for buyers to jump in if they're ready to find a home, and supply of homes for sale is growing. You can see that inventory, that month's supply, ticking up as the pace of home sales and more homes come back to the market. So certainly not easy to find a home, but right now there's no doubt it's still very competitive, okay? But definitely not as impossible as it may have felt for those of you buyers who probably stepped out of the process last year, the beginning of this year. So, a great message for you if you're a buyer. So as we wrap up the August monthly market report, the 3 things we went over: what's happening in the current market, why the market won't crash, and a look ahead for the rest of the year. To my friends who are realtors, lots of info here to get out to your clients to ease their fears, to help them understand what history tells us, and for you to lead most effectively in this space to help your clients make powerful and confident decisions so they can jump into the market when the time is right for them and can make those decisions based on what the data is telling us. There's a lot of fear out there, a lot of concern out there, and the data can help change that story for you and your clients. So be sure to subscribe, guys. If you're a realtor, all kinds of masterminds and tools we're doing weekly. You're always welcome to those. All agents, all companies, we're getting those in here. If you're a home buyer and seller, we're adding lots of content for you here weekly as well. Lots of great things. So subscribe here to my channel. If you have any questions for me, leave them there. I will down in the comment section put all the resources where all this data came from. That will be down here below. I appreciate getting on here. We'll be back next month with another one of these. Thanks for taking a look. Thanks for watching. Have a great rest of your month of August. Talk to you soon. Bye-bye.